Good afternoon, everyone. Dan Gerard, Managing Partner, G9 Financial, coming to you today with Jasen Dahm from Tag Invest. Jason is a strategic partner of ours, helping us build out client customized portfolios. Jason is a CFA, and Jason's on today to really give us a kind of review look back of 2023 and a forward look of what 2024 is, or could be, I should say. This is meant to be very high level. Obviously, should you have any questions, concerns, please reach out to us directly afterwards. So Jason, with that, if you don't mind just giving us kind of quick high level overview of yourself and Tag Invest and kind of our relationship that we have.
Yeah, you bet, Dan. Appreciate you having me on. The relationship that we have, I should say my company, Tag Invest, provides services to advisors like Dan, like yourself. My entire business is really just helping advisors, being sort of the back office investment management strategic partner, and ultimately helping with case design, working with your individual clients. I've been in the role like that for just over a decade now with a couple of different firms. But manage right now just over $500 million in total assets across about 2,000 accounts. So quite a wide range of clientele that we work with here. But yeah, really working with advisors through the advisor as an intermediary to ultimately help and provide and place business and work on some strategic cases and on more custom basis, as well as on more kind of a standardized asset management relationship. So that's generally speaking what our business is.
That's awesome. Thank you, Jason. And we're excited to have you part of this today. I've known you for a year and a half or so, if not longer, and you've worked with a couple of our clients already along the way. And we're looking to build off that. And I thought this would be a great time for you to kind of give a market review and update of what you're seeing within the practice and the assets that you're managing, and just your thoughts, knowing that you're in the weeds of it every day.
Yeah, absolutely. I'm going to share my screen quick, and I'll just confirm quick. Can you see the Fight Club moniker up there?
We sure can.
Perfect, perfect. Okay. So yeah, this will really just be more of a high level of kind of I'll structure it as, where we've been, where we've gone, or where we are and where we're going. But I'll kind of kick it off. Fight Club is one of my favorite movies. And as I was kind of thinking about, putting this together, really the thought that came to mind to me is the very last scene of the movie. Edward Norton's character, the main character, says to Helena Bonham Carter, "You met me at a very strange time in my life." And I think that that's part of the narrative at this point that translates now to where we're at now in starting our strategic partnership. We're working more in deepening our strategic partnership with G9. It's a very strange time in the market. So I thought that that would be a good segue into where we're going at this point. But first, to look back, for equities, first of all, this is just the month-end performance as of last month in December. Would definitely be defined as a risk-on trade. All the equity indices had another strong month, extending the rally that they had started in November, as Fed Chair Powell's comments earlier in the month really reaffirmed investor suspicion that the Fed is likely done raising rates and is now pivoting and poised to really cut rates multiple times in 2024. The Dow, the S&P, and NASDAQ ended the year really on fire, and then saw positive performance for 9 straight weeks. Dow led the way, being up over 6%, while the NASDAQ and S&P both returned near 5%. It's worth noting that the S&P 500 actually hadn't had a 9-week winning streak since January of 2004. So we're looking at a 20-year run here, where kind of an unprecedented upward run to end the year. But it did come to a close last week, so we didn't continue that going into the new year, but rebounded a bit the following week. So really kind of back on parity where we were to end the year, now that we've bounced around a little bit here in January. The next slide is a zoom out, just looking at what 2023 as a whole looked like. So returns for the calendar year look even better. We had a poor 2022. NASDAQ was down a little bit, but led the way back at over 43%. S&P closed 2023 less than 1% away from its all-time highs and closed the year up over 24. And the Dow did reach new all-time highs, posting that number in late December and closed up almost 14%.
So with that, Jason, kind of a nice little rebound from the 2022 kind of rough
Yeah,
waters
exactly.
that
If
we
you
took.
zoom out and look at it over the 2 year period, you really kind of saw, the Nasdaq and the growth sectors really struggled as interest rates really kind of started their rate rising cycle. And then as we went to and kind of reverse trend on that, the Nasdaq and the growth stocks really outperformed in 2023. So kind of got us back on to parity with where we were previously, and ultimately did set some new highs as part of that. But it was really a rebound year more than anything.
Yep. Excellent. Excellent. And that's the key, right? Stay with the plan, not try to bob and weave to get away from the strategy you have in place.
Exactly. Time in the market is a bigger thing than timing the market. So making sure
Absolutely.
that you stay the course as part of that, because it's tough to say. I think earlier on in the year you would have probably predicted, a lot of the analysts and the street participants were really predicting kind of tougher times to come. And if you'd pulled your money at that point, you'd missed out on a lot of really good performance
Yep.
in the back half of the year, as sort of sentiment shifted as we went towards this this rate cutting cycle as opposed to rate rising cycle.
Yep. Agreed.
Which is a good segue into sort of the weirdness. So when I talk about that and why I brought up the Fight Club moniker in terms of the being strange times, the strange times are really coming from where we're at in the fixed income market. It's not a coincidence that equities really did fly up in Q4, because rates over that time period declined pretty dramatically. The 2, 10, and 30-year space. Most of the rate declines, occurred in November, but that trend really continued into December with the U.S. Ag rising almost another 3%, which is a pretty big move in bond market. The very front end of the curve, you can see on the illustration of the Fed curve, Fed funds currently sits at 5.5%, and will likely stay that spot until the Fed actually does start cutting rates, anticipated later this year. However, as those anticipated rate cuts are priced into the system, we've got the 6 and 12-month treasuries falling off, but ultimately at a spot where we are inverted on the yield curve, meaning the front end rates are ultimately higher than back end. That's not a normal situation. The expectation would be that as time progresses, you'd expect those rates to stack together, and ultimately over time you'd end up with higher rates on a longer term basis. So it's a little bit of a strange phenomenon that we're in right now. Have been that way for over 18 months now, that the yield curve has been inverted. So this market's clearly betting on lower interest rates to come. Another anomaly in the market involves those longer term rates, which are supposed to have low or negative correlation with equities. But in 2023, the 10-year bond had an approximate 80% correlation with the S&P 500, as compared to its historical correlation at 8%. So 10 times the correlation over that time period, over the 10-year history. So when you look at that and kind of and zoom back out and recognize, the story for 2023 really was the Fed being the tail that wags the dog, because as Fed policy changed, as the interest rate cycle moved away from rate rising to rate cutting or anticipation of that, that's really kind of where we've seen movement, and it's been in pretty much lockstep with the equity market. The next slide is really just a kind of jumped one too far ahead. Really gives us a summary of the high-level data points the Fed is going to be looking at to interpret how successful they've been at achieving what they call now their dual mandate, which is a split between their stated annual 2% inflation number, as well as trying to sustain maximum sustainable employment. Since I'm short on time, I don't want to spend too much time reading through all these specific data points, but just as kind of a general rule here, we're still at a spot where bad news is good news. You'll hear that floated around in sort of talking heads and pundits. But what that means is effectively that if the prints on these data ultimately come back to the Fed as being more positive, if the market is viewed as making strides towards accelerating and effectively coming out on what would be a hot print, it's implying to the market participants that inflation maybe hasn't necessarily been tackled yet, and that we could potentially see more inflation and overheated economy into the back half of 2024. So as a result, the Fed would be less likely to cut rates in that environment, assuming that they still needed to keep rates higher for longer to tamper that inflation and to keep that down. So that's where we're kind of seeing or thinking about that as those numbers come out. We really want to pay attention to how the Fed digests those and ultimately places them and adds that to their data points when they're considering what they want to do with rates on a long-term basis. Worth noting there too that at this point in time, the Fed, there's a CME watch tool that you can see and actually keep in real time based off of futures, what the expectation is for the Fed and how they're expected to act. Their next meeting is here in 2 weeks. The FOMC meets January 31st. Expectation here is widely considered that they're going to hold rates steady. Right now, it's a 97.4% chance that those rates will stay put, and only a 2.6% chance of a rate cut, with a 0% chance of rates going up. So we're definitely into the pivot of we're anticipating rate cuts, but there's a very low probability that's going to occur in the short term.
Yeah, and we were talking rate cuts. We're not talking, 2010 rate cuts here where they're going to go all the way down. So I look at the 30-year mortgage, track record here. It's from 7.3 all the way down to 6.61 in December. These are not going to 3.5 or 2.5%, but they're going to ideally, hopefully, become more reasonable as time goes on here.
Yeah, I think that what we had experienced over the last decade, the 2010 to really up until 2022, when this rate rising cycle started, was pretty unprecedented in terms of the rates that we had in place, kind of following the great financial crisis and everything that occurred out of 2008. I wouldn't expect us to get back to that anytime soon, if ever, just because it was such a weird time horizon. We didn't get to negative rates, but Europe and part of the rest of the world did go negative. Entirely, which again is kind of wonky math how that would even work. You're paying somebody to hold money for you in order to juice more activity within the marketplace. I don't see us returning to that. So when we're talking rate cuts, we're really just talking 25 basis points at a time. We're moving from 5.5 points, expectation down to somewhere in the 450 to 475 range, likely by the end of the year. So nothing crazy, but still a change from where we're at currently.
Sure.
And that plays itself out into, just because this is at the end of the year, you tend to get a lot of the forecasts coming out. The banks, the asset managers like to put forecasts of what they believe, your benchmark, your S&P 500, your Dow numbers would be. This is just a tweet that I had shared from Jonathan Farrow, who's an analyst at Bloomberg, showing the disparity between what various asset managers and banks have as their S&P 500 targets going into the year. And a lot of these numbers actually had to change. They had one number put out right before or right after Thanksgiving, and then right after the Fed came out and made their commentary, Chair Powell spoke on December 13th, they had to revise them again because so much had changed in that environment of now we're at this rate cutting cycle. However, if you look at kind of that disparity, the range here from Oppenheimer being the most aggressive at 5,200 to JP Morgan kind of being the bear on the street at 42, that's not really that wide of a range, which indicates to me that of all these different banks and asset managers, they're all sort of in the wait and see mode right now. They want to see what the Fed is going to do, how they're going to react to that data. It's difficult to make predictions in this marketplace because so much of what's going on and what drives where we're at is purely based off of how the Fed views the data and how they interpret it. So we're at this spot where I've been joking for a while that we're less concerned about what's happening geopolitically with Israel and the Houthis and Ukraine and stuff that's happening on the ground here with our elections and in individual company earnings. And we're more concerned about what Chair Powell has for breakfast that morning and what type of Cheerios he's eating and how that's going to lead to his indigestion around his data points. Like, unfortunately, that's where we're at. The Fed is just really driving everything. Everything else is secondary or tertiary to the Fed.
Sure.
Last piece and last slide that I'll share is really something that I follow pretty closely is volatility. It's also sometimes known as the fear index. Before this index spiked by over 10% to start the year, when we had a little bit of that sell-off post year end, we were approaching absolute levels that were nearing the lows of 2017 and 2007. So in other words, the fear really had left the marketplace. We were really at a spot where everyone was kind of in this level of complacency. And if history is any indication, if Fight Club tells us anything, it's that complacency can lead to chaos, and mayhem is but a sleepless night away. So it's one of those situations where don't fall into this trap that things are just going to be consistently easy and we're not going to have volatility, because the likely spike that comes behind that could be potentially severe. Not saying run for the exit, just be cognizant of the fact that volatility will kick up again and will likely lead to some level of choppiness within markets. So as we said earlier, making sure that you're staying the course and not getting too, trying to time too much, not jumping in and out. This is really a good point to say, stay the course, stay invested. If things get choppy, they'll come back and they'll ultimately return. But we have to make sure that we're aware of it, that is potentially on the horizon.
Yeah, and that is a theme that we stick to vast majority of the time with all of our client plans. Is there's really no way to get around the volatility, but you got to build plans to get through it, right? And time mitigates the risk over time, and I think that's important to point out.
100%. Yeah, if you look at I always like to describe there's an analogy of a bat flying through the cave, and if you're looking at the bat in short time horizons, if you could see transparently through that bat could be bouncing up and down, it could be going off the walls, the stalactites, the stalagmites, whichever direction those go, but going up, down, up, down. But if you view it outside of when the bat enters the cave versus when it comes out, and it looks like a straight line. So
Sure.
taking a view of, if you zoom out and just recognize that over the course of a longer time horizon, the line is much less choppy, it's more directionally sloped, and that's a better way of viewing your investments too. If you just look at it, take the zoom out view, longer time horizon, yeah, it's trending upward, and that's really the key. Don't worry so much about the short-term volatility or noise.
Yep, I 100% agree.
You bet. So that's the rest of it, Dan. So any other questions that you had for me?
No, not really, Jason. In essence, obviously the volatility is not going away. It's always going to be present. What I'm hearing is whether it's a war going on, an election going on, or someone eating a certain cereal for breakfast, maybe that, right? It's getting through these things. That is how you stick to the plan and come out on the other side of it. 2024 high level thoughts. Do you have any?
The thought that I have is really just, I think that we'll probably come out of that cycle. I think that we'll reach a point where the Fed has probably has projected enough. We've gotten the data points that we need to where we can really kind of start focusing our attention again on the things that really do drive markets and going back to fundamentals. So I would view that as being, a better environment for, higher profitability, better cash flows, things that actually do matter on the fundamental investing side to start mattering again, and geopolitical events to start mattering on the macro side. So that might lead to more swings, later on. But again, I think that it'll be less about what the Fed ultimately tries to do with this. I think they might consider their job, I wouldn't say ever done, and it'll always be a factor. But I think that it'll be less of a factor this year than maybe it was in 23 and 22, because a lot of the inflation, thematically, and the way that their rhetoric was built and the way that the pundits described it, the term transitory inflation was a big hot button number or hot button thing to talk about when this administration first took over. Obviously that didn't actually play itself out. It wasn't truly transitory. But again, if you zoom out over a long enough time horizon, you can't ignore the fact that a lot of this inflation did come on the heels of what was a very, very odd event in COVID and how that shut us all down. And as the rest of the world has digested that and ultimately has worked its way through the system, I think that the inflation will tend to wane, and then we'll get back to a more normal situation. And ultimately, rates will reflect that, and ultimately, markets will digest it as well.
No, agreed. Well, Jason, I appreciate your time. We appreciate the strategic partnership that we have with you and Tag Invest, and we look forward to hopefully a very prosperous 2024.
You bet. Thanks for having me, Dan.
Thank you very much, Jason. Appreciate it. Thank you.
Okay. Bye-bye.
Bye-bye now.